Hello, I'm Graeme Bibby, Chief Investment Officer. I'm joined today by Leong, who's Equity Portfolio Manager. And I'd like to start off with a bit of a recap of the last year and the last quarter and our views into the year ahead. Last year we started off with a view of we thought that this year was going to be a wide range of outcomes. We've seen that already. We've seen a big sell-off of the equity markets and rally back up. We've seen a big shift in policy, more so than what people thought. At the end of March, we saw that there would be more downside before we saw upside, and we saw that too. We think that there'll still be some volatility into year end. Although we see some risks of recession that have remained, we also see some resilience. We see earnings that are recovering. We see spending that's picking up from the consumer and business and cash on balance sheets. So we see some positives as well as some negatives, so a wide variety of outcomes there. So looking at the equity markets, Matt, what are we seeing there?
Yeah, so as you said, we've seen some resilience, both in terms of prices as well as earnings. And we've seen that drawdown quickly reverse, and we are now about flat to where we were at the start of the year. That's been driven by earnings revisions, which have now turned more positive again. In terms of the MSCI World, this chart shows the earnings for 2025 in blue and the earnings for 2026 in pink. And for 2025, we can see that earnings expectations came down through the tariff volatility and bottomed out in mid-May before rebounding a little bit. That's underpinned the resilience or the rebound of the equity market. And we can see here that earnings are still expected to grow about 7.5% for 2025. And markets always look ahead, where earnings are expected to grow about 11.5% for 2026. And that's driven a more constructive outlook for us as well. Earnings have been helped by a lower US dollar, which has helped offset a lot of currency issues. They've also been helped by supportive fiscal and monetary stimulus, which has supported liquidity levels and kept consumer spending. So what we've seen is that although consumer sentiment has deteriorated, and in some places like the US, they are fairly pessimistic, consumers continue to spend and have continued to support both the economy as well as earnings. As a result, our outlook for equities, they're pretty constructive, but we do expect more volatility, as Graeme pointed out. However, we do tend to see markets see through that volatility, and we believe that staying invested for the long term is still very important. In terms of rate cuts, we have seen a couple of them come through. Graeme, what's your view there on the fixed income and bond markets?
Well, we think that the rate cut view, there's going to have further cuts both in Australia and in offshore markets, particularly the US. What we've seen from two sides of the market, one is the credit markets, which is the combination of corporate issuers and financial issuers such as banks versus government bonds. Starting off with the corporates though, so back one, we did see that correlated to equity markets. So during this period in March when people were anticipating that there'd be some tariff action, that then spiked from Liberation Day right up, and that corresponded to equity markets selling off. So that was the view that recession risk was rising quite dramatically and that you were likely to see a flow through in challenging conditions for corporates. That's come down quite dramatically as the deferral of the tariff program happened, and we've seen a normalisation of risks, almost back to the levels, not quite, of where the credit spreads were before. So that's on the corporate and banks and financial side. On the government bond side, on this chart, it's been very volatile over the last year, as we've seen from earlier times, recession risks being priced in and out. And a lot of that movement is due to that sort of view and the dimension of where cash rates are moving in response to that and the policy of the Fed and the RBA and others. But we've found during the tariff period, it actually didn't move that much. We were probably expecting, and policymakers were expecting it to come down more, but that actually didn't happen. That was part of the reason why there was a policy pivot to defer the tariff implementation and move towards more the fiscal stimulus that you're seeing with the One Big Beautiful Bill that's being voted through, with lots of government stimulus coming through. So overall, that's a very sort of choppy bond market, but overall it's been neutral in our view for bonds from the government side and from the corporate side. So that's been our positioning on the bond side. Then flowing through to our overall positioning and outlook, wrapping up, Matt.
Yes, so in terms of portfolio positioning, we have had a more positive view on global equities again, owing to that resilience in both earnings as well as policy support. As a result, we have added back to global equities and have moved back to neutral from a slight underweight. As I said before, we do see a constructive outlook, although we do expect further volatility. We expect to remain invested through that period. For Australian equities, that's a different view. We remain slightly underweight and we don't plan to add back at this stage. The reason for that being multiples are more expensive for Australian equity. Also, when we look at earnings on Australian equity, we do see less resilience. Revisions have been coming down and continue to come down for Australian equity, and we see further headwinds there given the large exposures to a couple of sectors that do not have supportive tailwinds at this stage. And as Graeme said, in terms of fixed income, we're fairly neutral. We do expect volatility to continue in fixed income as well, but that is offset by a pretty decent yield that we're currently getting with a more favourable backdrop of central banks cutting rates. And Graeme, what about the outlook for privates and alternatives?
Well, the private market outlook's pretty resilient, and it has been resilient through this period, particularly of tariff disruption. What we've found talking to our fund managers is that many of those underlying companies were purchasing equipment and preparing ahead of this. So we've found that the tariff sensitivity for the underlying businesses hasn't been as high as public markets, but also they've had less volatility because they mark to market less often, and they've been able to carry through this period without the drawdown in price. So overall, combination of two things. One is that they've managed to be proactive, and the other is that they've just had a smoother experience through that period, and we expect them to perform pretty well into the year and years ahead. Overall, that's our view on the outlook for this year and the quarter. Thank you.
Thank you.